U.S. inflation rose just 0.1% in March, marking a 5% on-year increase. With a slowdown in consumer prices, will the U.S. Fed stop its key interest rate hikes? Our Seung-jae takes a look.
According to the U.S. Labor Department on Wednesday, the U.S. Consumer Price Index rose just 0.1% in March, up 5% from a year ago. The latest data marked a lower figure compared to Dow Jones' estimates of 0.2% and 5.1% respectively. However, core CPI, which excludes food and energy, rose 0.4% on month and 5.6% year on year. While the latest data shows that inflation is still far from a figure the U.S. Central Bank feels comfortable with, it's a sign that consumer prices are slowing down. But is this a signal that the U.S. Fed will start freezing its rate hikes? Minutes from the March meeting of the Federal Open Market Committee showed that despite indications that the U.S. could suffer from a mild recession in the second half of the year, it still decided to raise its rates, albeit by just 25 basis points. Some FOMC members cited the collapse of Silicon Valley Bank and the impact of the overall banking sector as the source of the mild recession to come. In fact, several Fed officials considered a rate pause in March, according to the latest minutes. While the current inflation levels are far from the target of 2%, many economists now predict the U.S. Central Bank will begin slowing down its rate hikes and potentially even freeze rates during the next policy meeting in May. With the minutes indicating that a potential U.S. recession will take 2 years to recover from, some experts expect rate cuts to happen earlier than expected, despite U.S. Fed Chair Jerome Powell previously stressing that no rate cuts will happen until after 2023. Seung-jae, Arirang News.